So here is the question I keep getting. How do you protect your money when markets start falling apart? You see, when volatility hits, most people run straight to the cash. They panic. But here is the truth. In every market cycle, there is a group of companies that don't just survive chaos, they thrive in it. And they are not flashy. They are not in Silicon Valley. They are just boring names. You have seen your entire life Colgate, Kimberly-Clark, and CVS Health. Today, I am going to show you how these boring companies quietly outperform during uncertainty, why the smartest institutions load up on them, and how you can use them to stabilize your portfolio while still earning yield. Because when you understand what these stocks really represent, you will realize they are not just safe, they are strategic. Let's zoom out for a second. Right now, global markets are caught up between two opposing forces, inflation and slowing growth. The Fed's playing tug war, so trying to cool the economy without breaking it, while consumers are squeezed by higher living costs and mixed corporate earnings. This is the kind of environment where risk-adjusted returns become everything. That's why big money doesn't run out of the market. It rotates within it and out of growth into defense. Defensive stocks are those that don't depend on booming economies. Whether GDP grows 3% or shrink 2%, people still brush their teeth, still buy diapers, still fill prescriptions. That's what makes them the sleep well at night stocks. If you understand how to balance your portfolio between offense and defense, you stop gambling and start investing. So let's start with Colgate Palmolive, a company that's literally built on habit. Most people say toothpaste, but I see a 200 years old subscription model that doesn't need a subscription button. Colgate operates in over 200 countries, with 45% of its sales coming from emerging markets where population and incomes are still growing. During the 2008 crash, when the S&P 500 was down 38%, Colgate fell only 5%. And within 6 months, it had fully recovered. That's because oral care isn't optional. People don't delay brushing until the economy improves. And while most companies fight to keep customers, Colgate brand loyalty is generational. Parents pass it to the kid. That's what I mean by behavioral predictability. It's not sexy, but it's stable. It's raised dividend for over 60 consecutive years. Think about that. It's paid shareholders every single year through wars, inflation, and recessions. That's not a company, that's a financial fortress. Next, Kimberly-Clark, the company behind Huggies, Kleenex, and Cottonelle. They don't sell luxury, they sell necessity. Even during the pandemic, when consumer spending shifted and inflation was high, Kimberly-Clark raised price by 9% and people still bought the same amount. That's called pricing power, and it's the holy grail of defensive investing. They have quietly compounded for decades, over 50 straight years of dividends growth. And the secret, their business sits inside something economists call it inelastic demand. Meaning, when price go up, demand doesn't really go down. In 2022, while tech stocks lost over 30%, Kimberly-Clark total return was positive. Investors weren't chasing hype. They were protecting purchasing power. That's why big funds park billions here. It's not about excitement, it's about resilience. Now let's talk about CVS Health. And this one is quite fascinating because CVS has transformed from a pharmacy into an entire healthcare ecosystem. They don't just fill prescriptions, they own the insurance companies, run clinics, offer telehealth, and now primary care through their minute clinics. During the 2020 pandemic, CVS didn't slow down. It became essential infrastructure. At one point, they administrated over 70% of US COVID vaccine in their stores. And while markets crashed, CVS operates income increased 8%. That's what true diversification inside one company looks like. They have positioned themselves perfectly between healthcare and retail, and that gives them multiple profit streams without needing speculative biotech bets. So while most investors were chasing the next Moderna, CVS quietly compounded and built an ecosystem that people use every day. That's how you build a new edge defensive stock. Now, how do you actually use these companies in your portfolio? Here's how I do personally. Defensive stocks aren't meant to excite you, they're meant to protect you. When growth slows, they preserve your capital. When growth returns, they fund your next move. Think of them like the foundation of your house. You don't see it, but everything depends on it. For most investors, a 20-30% allocation in defensive sector is ideal. It smooths volatility without killing your upside. And here is something most people miss. These companies don't just pay dividends, they grow them faster than inflation. Colgate dividend yield right now is around 2.3%, but it's been growing at 5% a year. That means in a decade, your yield on cost double without you doing anything. That's real compounding, not just in price, but in peace of mind. So where do we go from here? We are late cycle, rates are high, earnings are slowing, and consumer sentiments shaky. So historically, this is when defensive stocks start to outperform the S&P 500. During the 2000 tech crash, consumer staples were down just 6%, while the Nasdaq fell 78%. In 2008, Colgate and Kimberly-Clark both recovered twice as fast as the index. And in 2020, CVS outperformed the S&P by nearly 25%. So that's not luck, it's a market structure. Big money doesn't panic sell. It rebalances into safety, collects yield, and waits for the next uptrend. That's how institutions win. And if you learn to think that way, you will stop reacting to headlines and start moving like real capital. So yeah, Colgate, Kimberly-Clark, and CVS, they are not exciting, but neither is watching your portfolio drop 40% in a panic. These are the companies that keep you in the game, that protect your capital when fear takes over, and that quietly compound year after year as well. Because remember, the goal isn't to look smart this quarter. The goal is still have capital next decade. And defensive stocks are how you do that. If you like this video, please click on subscribe button and share this video with those who needs to learn more about the stock. Thank you for watching.